Rent and home prices have gone up even faster than inflation over the last decade, and increasingly, weather is a factor. Building more homes does help decrease prices, but extreme weather disasters decrease home supply by making many unlivable and by keeping builders busy with repairs instead of creating more homes. But maybe even more important right now is this. We could be reaching a tipping point for housing in the US as insurance companies stop writing home insurance policies in places with high risk of disasters and others that go out of business altogether. 63% of homes in the US have mortgages. Almost all of those are required to have insurance to mitigate the owner's and lender's risk. But what happens if an insurer drops policies after an extreme event? It may mean those homes are overvalued. Remember the 2008 financial crisis? That was caused in large part by overvalued and risky mortgages. So when headlines like this start popping up in 2023, we had to look deeper.
If people can't secure insurance, how can a bank keep offering loans for homes and businesses? One or two major events could be the tipping point.
In this episode, we're going to find out what happens if an insurance market fails and show where the highest risk lies. We're also going to look at a solution that is just starting to gain momentum in California and turns this entire issue on its head. Maybe the problem and the solution has as much to do with how we spend public dollars as it does with the extreme weather itself. There's been a very clear upward trend of billion-dollar disasters in the US since 1980. 2022 saw 18 with a total of 267 since 2000. Texas, Louisiana, and Florida have been hit the hardest, with California and Puerto Rico coming in second. New York, New Jersey, North Carolina, and Mississippi also rank high on the list. Insurance is a fascinating lens into this change because the entire industry relies on accurate prediction and pricing of risk. If insurance companies don't charge homeowners enough to pay for future damages, they lose money or even go out of business. And in California, that risk is very real as wildfires get more and more destructive.
You can have a fire that consumes more than 1 million acres, and it only consumes 1,000 structures. That's spread across a couple dozen insurers. And while it was a really bad day for those families, the insurers can price and weather those kinds of changes. Here's the piece that becomes existential for insurers. Conflagration. When that fire intrudes into a suburban community and then you begin to watch the dominoes trickle down. That's what happened in Coffey Park in Santa Rosa, and that's what happened across 19,000 structures in Paradice.
According to the insurance consultant Milliman, the combined 2017 and 2018 wildfire seasons wiped out about twice the profits for the previous 26 years.
It is the successive nature of these disasters with large payouts that begin to rattle the insurance market. It really comes down to, will they still have the resources to continue to pay those claims farther down the road?
In order to protect consumers, California limits how quickly insurance premiums can be raised. But if the risk to homes goes up too fast for too long, the system breaks down. So companies in California started to write fewer policies in the most hazardous areas. To fill the gap, many states with high risk of weather disasters like California created insurers of last resort for homeowners that can't get market insurance, often called FAIR plans. All insurers that do business in the state pay into this backup plan to cover payouts for future disasters. The system collects all of the riskiest properties under one plan. The plans can cost homeowners as much as 4 times a market rate plan and often offer less coverage. If you're a homeowner, your cost goes up. If you're a renter, your rent probably goes up too.
That market is supposed to be a market of last resort. It's supposed to be a temporary solution. It's like a crutch. I would not fault a crutch for not being a very good leg. I think if you try to turn a crutch into a leg, it's never going to be a very good leg.
But as more and more disasters strike, more and more homes can't get insurance on the open market, so they go to state plans with no way to get out, putting more of the riskiest homes into one basket. Does that sound familiar? During the 2008 financial crisis, risky or subprime mortgages were often grouped together and sold to investors as a mortgage-backed security. As long as only a few ran into problems at one time, the system worked. But an overload of overvalued risky mortgages weakened the foundation. Soon, too many people defaulted on their mortgage at once, and the system collapsed. Today, the properties themselves are at risk, and extreme weather may be the catalyst that weakens the foundation. So, all insurance companies doing business in California are required to pay a fee that funds the public-backed plan to insure the riskiest homes. And the plan is growing. Between 2018 and 2022, its total policies more than doubled.
If the FAIR plan were to have a major event and there's billions of dollars of damage and their reinsurance is not enough to cover that, anything above that, the deficit, would have to be borne by the insurance companies in the market. There is a possibility that if the FAIR plan gets big enough, there will be an incentive for companies to leave the California market or to shrink their footprint so that they're not the ones paying the bill.
And that's exactly what's happening. Allstate, State Farm, and Farmers all stopped writing new policies in the state.
It's like being in a bar with your buddies and people throw some money down after they've been drinking for a few hours and then they leave and you just stay and stay and stay. There's not an insignificant risk that when that bill comes, there won't be enough money there and you're going to be the one that's left to make up the difference.
And it's not hard to imagine two devastating California fires in one year, like the Camp Fire, which destroyed 19,000 structures and cost over $10 billion in total insured losses. And as losses mount while insurers leave the state, it looks like the plan will continue to grow, adding risk to all insurers in the market, even if they choose not to insure the riskiest homes.
If we don't deal with the FAIR plan and the unlimited assessments faced by the admitted insurance industry, then there is an increased risk that the whole insurance market in California will collapse because of it.
And what happens if the insurance market collapses?
Real estate transactions would be severely disrupted. Home values would be impacted. The inability to get insurance, does not increase your home value. It's possible that banks might not be able to lend here.
If California were a country, its GDP would be the 5th largest in the world, so it could have very wide-ranging impacts on the global economy. The insurance industry in Louisiana and Florida is also fragile, making the risk national, if not global. But actually, we might be looking at this from the wrong angle. What if we could just reduce the risk? Rates would go down and insurers wouldn't have to leave the state if it wasn't as risky, right? California created a funding package of $1.2 billion to prepare for wildfires in 2021 and 2022. That budget is outside of and additional to firefighting. 96% of it is spent on things like thinning forests, creating fuel breaks, and preparing for evacuation. The state has been investing in this type of work for decades. Even so, losses are growing and insurers are choosing not to take on any more business in the state. Why? Well, fire safety research finds that the most important actions to prevent homes from burning in extreme wildfire are changes to the home and the immediate surroundings. So maybe the problem is that California's public investment doesn't line up with the science.
We've done something for the West called a wildfire prepared home. It says there are a set of essential things that when you do them as a system, truly limit the probabilities that you're going to ignite. So it has 3 elements to it. You need to have a non-flammable roof. There's an element related to some building features, the vents into the attic or the undercrawl space. They need to have a mesh on there that's really, really tight so embers don't come in and then ignite inside your attic. And the third part of it is that 5 feet closest in needs to be entirely non-flammable.
This third-party designation is specific to each home and verifies for the insurance company that the homeowner has done exactly what the research shows will limit the odds that the home will catch fire. This designation focuses on the home out to about 5 feet and then to a lesser degree out to 30 feet.
People say, well, I put my fire break in. Well, your fire break's 10 feet wide. The embers went right over the top of it. Another community says, well, I have a 400-foot fire break. And I'm like, okay, when's the last time you maintained it?
There is nothing in this designation that requires changes to surrounding landscapes outside of the actual property in question. And it's starting to show promise. Gary Ledbetter lost his home when the entire town of Paradice burned, and he lost his insurance after the fire.
During the process of even deciding to rebuild, we went down the path of learning. We kind of think we know what the risk of post-campfire is. Can we mitigate it with a building approach, right? Is there technology, is there methods that could give us some level of comfort and confidence?
They rebuilt to the highest standards of the Wildfire Prepared Home Program.
We found an insurance company that understood what we're doing here and had confidence like we do that we can survive the next threat. And so Wildfire Prepared Home is a designation, right? It's something that you can show a certificate. And behind that certificate is a team of scientists with an amazing facility in South Carolina where they test different scenarios. So that's pretty compelling. And they responded with a favorable policy and favorable cost.
The Ledbetter's home was the very first to receive this designation, so we don't know how insurers will respond over time, but in the face of growing disasters, following science and focusing on preparing homes could work for weather threats all over the U.S. IBHS and other organizations also have recommendations for fortifying your house against wind, hail, and extreme rain.
I think up until this point, home builders, homeowners, home buyers were ignoring climate risks. I think that will change now that we're seeing some consequences from the insurance providers.
What about where you live? Have your insurance rates gone up, or have you lost insurance altogether? What ways do you think about preparing your home before disaster strikes? Let us know and stay safe.